Good morning and welcome to a webinar on capital allowances. I'm John Lovell. I'm Managing Director of capital allowances firm Lovell Consulting. I have a background in this area of 30 years doing capital allowances specialist valuations. My background is firstly as a quantity surveyor and then as a tax specialist. And I'll be using my kind of practical experience day to day, going through case studies and hopefully explaining things in a simple and as practical a way as possible. And thank you to all those of you who've broken away from your Zoom calls and helping your children. My 4-year-old daughter was struggling a little bit this morning, and I offered to help her, and I said, I can give you the benefit of my brain. And she said, Dad, you just have a medium-sized brain. I can do it myself. Well, hopefully my medium-sized brain will be sufficient to get through this webinar. If any of you have questions, feel free to post them during the webinar, and also feel free to post them at the end. We will respond to all of the questions. The responses will be anonymous, so nobody will know your identity. So feel completely free to ask as many questions as you like. Also, if any of you would like CPD certificates, again, send us an email and we will email a certificate back to you. So I think we've got most of you present now, so I'm going to make a start. And what I'm going to be focusing on mainly is how to get cash refunds from HMRC. And what we have been doing a lot of work recently is getting savings and cash repayments for individuals and companies where they've had tax to pay on pre-corona profitable times. So that's been quite valuable, and we'll be running through how some of those case studies have actually worked in practice. Now, just to set the scene, what are capital allowances? Essentially, all governments around the world encourage people to invest in their economies. And the UK has a pretty generous tax regime. It's different to Central Europe, and it does come as a shock, particularly to newer business people, that when they spend money on buildings or fitting out their premises, they kind of automatically expect they will get full tax relief for all of their expenditure. In some jurisdictions, that's broadly true. Nobody really gives tax relief for land acquisition costs, but in other jurisdictions, there can be total tax relief for construction and property expenditure. But it's normally spread over quite a long period of time. In contrast, the UK tends to accelerate these allowances, and particularly in the last few years, the UK has been quite generous, and the first $1 million that you spend on any type of plant and machinery, you can write it all off in the first year in most cases. The UK is also generous in that in a lot of instances, you can keep the benefits of these tax incentives even after you've sold an asset. Whereas in most other jurisdictions around the world, capital allowances are purely a timing benefit and there's a clawback on sale. So the UK is generous in those two respects of getting allowances quickly, and secondly, being able to structure things so that you can keep the allowances that you have claimed. How does it work? Well, essentially, they reduce taxable profits. So in an extreme example, looking on the left in option 1, if a business had profits, it could be rental profits or it could be trading profits for, say, a retailer, of £1 million, then in very simplistic terms, if they had no bank debt and they had no capital allowances, they'd be paying very substantial income tax or corporation tax, depending whether they held it personally or in a corporate structure. Alternatively, the situation most people would try to get to is option 2, where interest is used to shelter some of the profits and capital allowances. And that combination of bank interest and capital allowances is extremely potent and substantially reduces taxable profits. Now, in the last few years, most governments around the world have been restricting the amount of bank interest that can be offset. So that is very much a global trend within taxation to prevent people fully sheltering profits purely with loading up businesses, loading up properties with a lot of debt. So there are now restrictions in the UK where interest costs exceed 2 million. There are currently no restrictions in the UK on the quantum of capital allowances that can be offset. So the capital allowances have become even more valuable to companies and individuals where they're impacted by the interest restrictions. So essentially what it means is the government tries to stimulate investment in the UK economy by giving tax incentives to encourage people to invest. The nice thing about what we're talking about this morning is there's nothing about schemes, there's nothing artificial. We're only talking about getting a tax advantage that governments intended on the back of legitimate investment. So there's nothing scheme-like or artificial or contrived about any of these actual case studies that I will be taking you through. The first example was a company that had paid corporation tax of about £500,000. They paid in advance on account, and their trading period up to September 19 was still good. This was pre-corona, and this particular company was in the leisure business. So they had a leisure business, and then corona came along, and they've basically been closed down completely since March. So severe impact on the company's cash flow since March 20 onwards. Now, we were introduced to this company, and they had, in the previous years, constructed a new stadium and spent substantial amounts building a stadium. However, even though they'd been tax-paying in the time that they'd been building, they had not fully claimed all of the allowances. And this is not unusual. And the reason for this was their accountants and tax advisors had a pile of invoices, and for the invoices where it was clear it was machinery and equipment, the allowances had been claimed. The problem area for the accountant, and a not unusual situation, were the invoices to the builders. Those just said building works, stage payments. The building project had been a design and build type of procurement, and there were, in any case, very few cost breakdowns available of the construction works. So we were able to say, well, that lack of information is not a problem. We visited the property, we collated the information that was available, and as capital allowances valuers and specialists, we were then able to segregate in a lot of detail the costs that were not nicely broken down. And as a result, we identified an extra 4 million of allowances. And they were then able to file an amended tax return, and they were able to get an immediate cash repayment of 300,000, and they were able to carry forwards some extra allowances to future periods. So in this particular example, we could have claimed allowances in a current year or future year, but the value to the company was to amend an earlier tax return for which they had actually already paid corporation tax. And this is completely legitimate. Those allowances are given to encourage people to invest. And if you miss claiming all of the allowances that you're entitled to in a particular tax year, there's nothing to stop you claiming the missed allowances or extra allowances by amending a tax return if it's still open, or in a current tax year if the property is still in use. So a nice example of helping a business. We work on much smaller numbers as well. Those are relatively big numbers. I use quite big numbers in these slides just because it's easier to illustrate the point. Second example, again, a very recent case and an actual case. We came across, as a result of a similar webinar to this, somebody picked up on the fact that there's tax relief available for decontaminating land. So if there's asbestos in the ground, oil pollution in the ground, and provided the person cleaning up the land is not a polluter, then there is special, very generous tax relief available. For occupiers and investors, there is 150% tax relief available. For property developers, because they already get 100% tax relief by full tax relief on all of the development costs, a developer just gets an extra 50%. Now, in this example, it was a mixed residential commercial development site just outside of London, and the site had been very heavily contaminated. And the owner of the site had nobody had flagged to them, despite them having Big Four accounting firm, tax advisors. No one had flagged the benefits in segregating the decontamination expenditure. So we were engaged. We worked with the project managers. We worked with the quantity surveyors. We collated the information necessary, and we broke down the costs to fully identify all that had been spent on remediation. And in this particular case, we identified 14 million of expenditure that had not previously had any tax relief. This particular client had tax losses, and as a result of that, there was kind of no benefit to them claiming this particular allowance. And with land remediation expenditure, it is possible to surrender the tax benefit to HMRC and get an actual cash payment. So in this example, again, it was very helpful to a currently cash-strapped property developer. We were able to get a cash repayment for them from HMRC of just over 3 million. This is an opportunity that we find is missed a lot. So the reason for it is the accountant, the tax advisor, again, they will just get a pile of invoices. Those invoices may say building works or substructure, excavation, earthworks. They will very seldom be broken down to the level of detail referring to decontamination. They may be, if there's asbestos removal, there may be a specialist contractor, say, for asbestos removal, and in that case, they may just very narrowly claim the costs of the asbestos removal. It is possible to increase these costs by allocating things like associated builders' work, associated overheads, the contractors' preliminary costs, and advisory professional fees like architects and specialist engineers. So in practice, we find that very few companies fully claim this tax relief, which is given as an incentive to help companies to remediate land. It's available to companies. It's not available to individuals. This particular tax relief. Other capital allowances are available to both. Another very current example, we were contacted by a company who had bought an office building for 10 million and they then refurbished it, spent 2.5 million, converted it into a private school. And it was not for young people, it was for mature students. And they hadn't claimed any allowances to date. Again, they were impacted by Corona. They've had to close the school and seen substantial reductions to their profitability. We were able to get allowances on part of the purchase price. There was plant in the building, there were lifts in there was some heating, air conditioning. So you have two opportunities to claim allowances. Firstly, if you buy a building, and secondly, you get another bite to allowances when you fit out or refurbish a property. And on the refurbishment, we got allowances on basically all of the expenditure, either as plant, repairs, or the new structures and buildings allowances. So this particular client, again, they paid tax on account, and we were able to amend the tax return, resulting in a repayment of overpaid tax of 400,000. The client will also get the benefit of savings going forwards when they have future profitability. Another example, again in the post-Corona period, we did some work for a high street retailer who'd spent just over $1 million replacing light fittings with energy efficient light fittings. And similar to the contaminated land relief, it is possible with enhanced capital allowances, green energy, energy efficient plants, you can either claim these allowances and get 100% tax write-off in the year that you incur the expenditure, or if you're loss making, you can surrender the benefits to HMRC. So this retailer, like most current retailers, were struggling a bit, didn't have profits, decided that the cash repayment was the most valuable to them. And so in this example, they got a cash repayment from HMRC of just over 150,000. In this instance, HMRC keep 1/3 of the benefit, which is why you take the total allowances times the tax rate times 2/3. So for anyone who has spent money in the past, and it's possible to go back practically over a 10-year period and look back in time, it is very worthwhile spending time in these challenging conditions, looking back, reviewing any situations where people have bought buildings, fitted out, incurred expenditure on them. And it's a relatively quick exercise to look from the tax returns. It's possible to find out what allowances were claimed and then figure out what extra allowances the individual or the company are legitimately entitled to claim. We find that allowances tend to get missed, and it's not through any negligence normally of advisors. It's normally because their clients just give them poor records, poor information. And the invoices that have been agreed for construction purposes, they just don't break down the information to the level of detail that HMRC would want to see. Also, we find that where clients have bought buildings, there may sometimes be an agreement in the sale and purchase contract to a capital allowances figure, and that's referred to a tax election. I'll talk about that in a little bit more detail later on. But there is a tendency without asking any further questions to accept those figures on a tax elections. In some case, that may be the correct approach, but with a little bit of forensic research, you can very often find opportunities to claim more allowances. And as I keep mentioning, there can be a reluctance by some accountants to look back at what has happened in the past. There can be an embarrassment factor to revisit a client who has claimed maybe not all of the allowances that they could have done. In practice, though, we find that clients tend to be receptive. It's possible to make those increased claims in current periods, and most sensible clients will understand this is a complex area, and if someone is offering them a saving now, they're going to be quite happy about that. And we also find where there are mixed ownership structures on property. So sometimes a property is owned by a part non-taxpayer or part charity, part pension fund, and part maybe by a tax-paying entity. Very often the allowances are then not picked up because relatively few of the owners can benefit from the allowances. But if, say, a percentage is owned by a tax-paying investor, there may still be a substantial benefit to that tax-paying investor. So do consider those situations where there are mixed ownership. Let's just take another example. Someone here has bought a building for 5 million and they bought it from a non-taxpayer. So it could have been from a charity or a pension fund. And in that situation, there will be nothing in the purchase contract about allowances. The allowances will be silent. So there'll be no tax election. And for that reason, most clients, most advisors would not claim any allowances. Whereas a specialist can check the entitlement, visit the property, schedule out the plant and machinery, and on a building of, say, 5 million, there could be allowances of, say, up to 1.5 million. Then in the same building, there's been a refurbishment. Someone spent $1 million refurbishing the property. Most accountants will claim some allowances here. They'll claim where the invoices are detailed, but again, where the invoices just say building works, that's a problem, and it may be worth engaging a specialist. So essentially, what this slide indicates, there's a lot of situations where a specialist can review the allowances that have already been claimed and very quickly figure out whether more allowances are due. There won't be more allowances due in every situation, but we find in at least half of the situations that we look at, we can normally identify extra allowances. Who can benefit from allowances? Well, it's the tax-paying entities. So it can be husband and wives, it could be individuals, companies, and also offshore companies. So there is a little bit of a myth that offshore entities are not able to benefit from these allowances. It's totally untrue. Provided the property is sited in the UK, then there's an obligation to file a UK tax return, and it's possible to claim these allowances in the UK tax return, irrespective of where the property is held. So even if a property is held in Panama, unusual, more likely BVI, is still an entitlement to claim. Allowances go with a land interest, and you don't have to own the freehold. So someone who owns maybe a newspaper shop and they've got a leasehold interest, if they carry out building works under that leasehold interest, they're also entitled to claim allowances on their expenditure. Different types of owners can claim. Most of what we're talking about today relates to occupiers and investors. Property developers are treated differently in tax. So property investors cannot claim conventional capital allowances. The reason for that is it's shown as trading stock and it's not capital expenditure. As I mentioned, though, in my contaminated land example, developers can unusually claim and benefit from contaminated land relief. There's a new allowance called Structures and Buildings Allowance, which applies to the shell of the building, the structural elements, the walls, ceilings, roofs, anything that kind of structure. Developers, again, not entitled to claim that particular allowance. Occupiers and investors can claim all allowances, as can all offshore investors since April 2020. Before April 2020, offshore investors were taxed as individuals and were denied being able to claim decontamination allowances. Individuals can claim all allowances except for decontamination. The non-tax-paying sector, pension funds, charities are not entitled to claim these allowances. A good point to note here is if you buy a building from the entities not able to claim allowances, you're likely to get a lot of allowances. So, if you buy a building from a property developer or a charity or a pension fund, those entities will not have been able to claim any allowances on their expenditure. So there's likely to be a good opportunity where you buy buildings from non-tax-paying entities. How do you make this process work when you're buying buildings? What we find in practice is whoever thinks about capital allowances first tends to get the best result. And we find the best time to consider allowances is at offer stage, when there's an offer letter, when the surveyors are drafting the heads of terms. And at that stage, you just want to have very simple, clear wording of who gets what in terms of allowances and how the process is going to work. At some contract stage, the wording needs to be a lot more detailed. Property lawyers are good at drafting wording, but it can be very helpful if there's a capital allowances specialist in the background steering the property lawyers. There'll be some situations where the allowances are very material to a transaction, and there'll be others where the allowances are not worth bothering about. And a capital allowances specialist can work with the lawyers to make sure the right kind of wording goes in the contract and to flush out what the history is in terms of the allowances. One of the problems is there are, in the questions that buyers and sellers ask each other, the CPSEs, there are about 10 or so questions on capital allowances. And the unfortunate problem is very often those questions are struck out saying not applicable or not known, or sometimes the responses are a complete work of fiction. And that is difficult for a property lawyer to piece together how relevant, what has happened in the past. So it can be worth a capital allowances specialist who can look through the history of the building, look at former owners, forensically piece the history together and work out what allowances the buyer is potentially entitled to. So as a firm, we do a lot of work behind the scenes. We don't advertise our presence. Buyers, sellers on the other side will most probably not be aware of our involvement. We will discreetly be working closely with property lawyers to make sure that the client gets the best result possible. Capital allowances should never be a deal breaker. People buy buildings for good commercial reasons, but by working closely together with the lawyer and the clients, it's normally possible to get a good result. But there will still be situations where clients will choose to buy buildings where there are zero allowances, because commerciality is far more important than a tax advantage. Having said that, by working together, you might be able to go from a position of getting zero to getting substantial allowances. Also, a lot of lawyers will do reports on title. They will give an opinion to their clients about the capital allowances. I would say that's quite a dangerous area for lawyers and accountants unless it's a very simple transaction. And I would suggest that in their reports on title, they may want to put some wording like this just to limit their risk and basically recommend that this is a specialist area. It may be that the seller's offered a tax election for £1, and just to question, well, are there any more allowances over and above that £1 figure that the buyer can now claim? So just be careful. Where we do see PI claims against professionals, it's quite often in this area that they've said, there's no allowances available, and there could have been if things had been treated slightly differently. What is a great capital allowances result? Well, I've referred to this as a golden scenario. And forensically, we have to piece together on every transaction the history. And on this particular example, we're advising the buyer, who's a tax-paying entity. So as a taxpayer, he can benefit from these allowances. And the seller is a pension fund or a property developer. So in this example, the seller will not have been entitled to claim any allowances. And again, we track back that the first owner here was also a property developer. So we have what's referred to as a completely clean entitlement. Previously, nobody has been entitled to claim any allowances at all. So this is a golden scenario for the buyer. He will be able to claim full capital allowances if there is this kind of history. And the buyer will be able to claim allowances for general pool, integral features, and potentially structures and buildings allowances. So if this was, say, an office, there could be allowances available to the buyer of up to a third of the price he's paying. And that would still be the case even if the lifts and the heating were quite old, because the allowances are valued by reference to the price being paid at the transaction date. So very substantial allowances normally available if you have this kind of tax history. It will depend from type of building. So if it's something like a farmer's shed that's being bought, then the allowances may be very small because there's just not going to be much in the way of plant and machinery in that building. Another good situation, I've referred to this as a silver scenario. It's a little bit more complicated here. Again, we're advising the buyer, and early in the transaction, you identify that the seller was a tax-paying entity, and you find out that they claimed allowances of £1 million, and the seller has been well advised, and in the heads of terms, they've basically said the buyer is only going to get capital allowances of £1. What this means is the seller is keeping allowances of the whole of the million. Again, the UK is quite unusual, quite generous. You can even keep allowances that you haven't claimed, and you can offset those allowances against income from other properties, provided it's been structured properly. So a lot of advisors in this scenario would be saying to the buying client, you're only going to get allowances of £1. So that's what you've commercially agreed to. That's what you signed up to in the heads of terms. There are only allowances available of £1. Now, a capital allowances specialist would note from the dates, and Land Registry confirms this kind of information, that the seller only bought that property in 2007. Now, the legislation changed in April 2008, and there was a wider definition of plant and machinery. A new category of allowances were introduced called integral features. So in this example, the seller could not have claimed allowances on general lighting, general power, cold water, solar shading. So straight away, the new buyer without any cooperation on this point from the seller, can claim extra allowances over and above the agreed tax election for £1. And for something like an office, it may be possible to attribute, say, 10% of the purchase price being paid now to these extra unclaimed integral features. So I refer to this as a silver scenario. It doesn't always apply. It depends on the fact pattern. But if this does apply, it can be great news for a buyer who's expecting nothing or just £1 or a very low figure, and then suddenly they can make a top-up claim to allowances. You may also find in this situation that the seller has refurbished the building, relatively recent, and maybe not got round to claiming allowances on their refurbishment. So there may, if that applies, there may be an opportunity to claim more allowances on top as well. I've got another slide here which hopefully illustrates this point. So let's imagine that you have the great fortune of advising Mr. Trump, and he's buying a building now from his best buddy, Mr. Biden. And right at the start, you find out that Mr. Putin was involved behind the scenes. And the first thing you have to do in any capital allowances transaction is look back at the history. So you would find out forensically and by asking questions that Putin had claimed allowances of 20 million, signed a tax election with Sleepy Joe, who was quite happy to sign a tax election for just £1. So that means that Putin has kept all of the 20 million and is the reason why Joe has not claimed any allowances. Now, then you're advising Donald. Does it mean Donald gets just the same £1? Well, a lot of advisors would look at this transaction and they would say exactly that. There's a £1 tax election between Putin and Joe. That £1 is binding on Donald. However, straight away, first opportunity is Joe could have claimed allowances for the integral features because he bought that building in 2009. Putin only bought it in 2006. Putin wouldn't have been entitled to claim allowances on the lighting, the cold water, and the solar shading. So Joe could have claimed extra allowances. Could be, 10% of the 50 million. It could be 5 million of unclaimed allowances. So if you're acting for Donald, you try and spot that kind of opportunity, and you'd put some wording in the sale and purchase contract that Joe would, within 2 years of completion, he would pool or claim those allowances if he's entitled to, and transfer those extra allowances across to Donald. So straight away, quite substantial allowances. So that's opportunity one. Opportunity two, Biden probably didn't like Putin's austere fittings, ripped them out and refurbished it. So again, if you discover that Biden hasn't claimed any allowances on his refurbishment expenditure, there's the opportunity to transfer those allowances across to Donald. And a third opportunity could be that Putin or Biden, they put substantial expenditure on plant like lifts, air conditioning. They could have put some of that through the service charge. It would have been revenue expenditure, no allowances claimed. Potentially Donald, without any cooperation from the sellers, could also claim allowances on expenditure that had gone through the service charge. Another area as well could be that Donald is inheriting some movable equipment, could be furniture coming across, there could be carpets. These are not fixtures. The Capital Allowances tax election, section 198, only apply to fixtures. They are only binding in respect of fixtures. And most people forget that point. So if movables do come across with a building, which is common with things like hotels, nursing homes, can be with other types of buildings also, then additional allowances can be claimed on top. So what this slide, and I've laboured on it quite a bit, it illustrates that tax elections for £1 or low figures are not always the correct figure. And working with a specialist, it's possible to forensically piece the history together and see what extra allowances can be picked up. So I would recommend to all of you, it's worth looking back over a 10-year period to see whether all allowances were properly identified at the time, provided you still own those properties, or if it's leasehold, if you're still leasing the same space. So there are a lot of misconceptions in this area. There's confusion about the time limits. A lot of people think unless you claimed all the allowances in a particular year, then you've lost the right to claim more. That is not true for plant and machinery and repairs, provided they're still used in your trade. You can claim in any open tax return. An exception to that is the new structures and buildings allowance, which I'm happy to explain to anybody separately. If you have made a decision to claim structures and buildings allowance, once that tax return is closed and final, normally after 2 years, then it's not possible to reallocate out of relatively slow structures and buildings allowances into much faster plant and equipment. There is also a very common misconception with a lot of accountants that if you claim allowances, you'll end up paying more capital gains tax when you sell an asset. That's not the case for fixtures in buildings. The capital gains calculation is completely neutral, and you can keep the full benefit of the allowances that you've claimed by putting in a Section 198 tax election to keep these allowances, and you will not pay any more capital gains tax, with, again, the exception of the structures and buildings allowance. So you have to think very carefully sometimes if claiming the relatively new structures and buildings allowance is the right thing to do. There's a lot of clients who assume that because they're using very good accountants, or they're using very good offshore trust companies to manage their affairs, that all of these allowances will have routinely been picked up. Now, I think if you've been listening carefully to these examples, you'll realise that's not the case. This is quite complex, and the allowances will only have been fully picked up if those accountants have in-house specialists, which some accounting firms do, or if you have a specialist working alongside you. So it is very much worthwhile, particularly in these challenging times where cash flow is difficult for many individuals, many companies, to see if these kind of efficiencies can be achieved. Another case study here. Somebody had bought a mixed office, mainly industrial building. They paid 1.4 million for it, and they then fitted it out, adapted the building to their requirements, and spent another $500,000 fitting it out. Now, this purchase was relatively recent, back in January 19, and they were able to benefit from the new structures and buildings allowances. And quite surprisingly, a very high proportion of the purchase price qualified for one type of allowance or another. So they were able to get allowances for general pool, that's things like sanitary ware, fire alarms, carpets, things which depreciate a bit faster. They were able to get allowances special rate on things which have a longer life, like lifts, air conditioning, heating. And then the balance of the structural spend, they were able to get the new structures and buildings allowance, which is spread evenly over a 33-year period. There was, though, no tax relief for the land, which we separately valued. So on a very substantial part of the purchase price, allowances were due. They bought it from a developer who'd not been entitled to allowances, so no previous claims, no tax elections were needed here because the seller was not entitled to allowances. And then it was the same story on the fit out, again, very substantial allowances. And I think what this slide shows is on properties, even where the purchase price is not huge, you don't need to be in the tens of millions, even in the millions or hundreds of thousands, allowances can still be very substantial, particularly with the structures and buildings allowance. Another example here, this was a private members club that had been refurbished. They had terrible information from their contractors, just a pile of invoices that didn't really say very much. And understandably, their accountants had hardly claimed anything in the way of allowances. They realized this was a specialist area. I think they came across us on Google, and we were able to segregate the expenditure. We got extra allowances of 1.7 million, and we were able to amend their tax returns that they'd been tax paying, and again get cash repayments. Now we can work where the information is really poor. We can visit the properties, we can value, segregate. We do very detailed calculations. We put those into a report. The report can then gets included with the client's accountant, tax advisor. We do not replace or duplicate what accountants, tax advisors do. And if there are any questions relating to our work from HMRC, we will defend our work. We get very few inquiries from HMRC. This is not a risk area, this is a compliance area, and if the work has been properly segregated, HMRC can see how the work has been put together, which tends to limit any inquiries. I'll talk very briefly on the relatively new structures and buildings allowance. When it was first introduced, it was spread over 50 years, which was hardly an incentive. It's now spread over 33 years at 3%. So my guess will be if the Chancellor wants to encourage further investment in the UK economy, he may speed up this rate maybe to 4% or 5%. I would hope that he will. It applies to contracts which started on or after 29th of October 2018. There's quite a lot of anti-avoidance around that date. You have to look carefully if there were enabling contracts. I'm not going to go into this in too much detail other than to say, unlike plant and machinery, you will pay more CGT as a result of claiming this allowance. So if you plan to only own an investment property for a relatively short period, you may want to consider whether you really do bother claiming this allowance. If you're in for the long term, then it's probably going to be worth claiming it. You will need an allowance statement from sellers, and that will apply even if the seller is not a tax-paying entity. It's quite hard to get those in practice because this is relatively new. A non-tax-paying seller will not have kept that level of detail. It's quite tricky. If you're buying from property developers, or non-taxpayers, then there may be significant SBAs available depending on when they spent money on the building. So we've talked about cashback opportunities. You can amend tax returns if they're still in time to amend, or claim in current periods. But the real opportunity is to look back in time. You can get cash back for surrendering the enhanced capital allowances. Unfortunately, the ECAs for the energy efficient plants, that incentive was scrapped in April 2020. We understand it may be replaced by a new allowance, maybe this budget or in the next few years. and you can get cash back for land remediation in certain circumstances. So there are a lot of opportunities in this area if you are paying tax in the last 12 months to 2 years to get actual cash repayments back and to claim increased allowances for future years. And reducing tax bills, obviously, is an obvious way to help with cash flow. And the key point is, in order to make additional claims, you still need to own or to use the asset in the period that you are claiming these allowances. A little example, a non-resident landlord here, they bought a property 6 years ago for 10 million, didn't claim allowances. They could have claimed allowances of 3 million, could claim in any open tax return, so very substantial allowances available. You could either claim in the current year or go back 1 to 2 years to amend a previous tax return. I've mentioned quite a bit the allowances available for decontamination. I've done that because it's very generous relief, 150% tax relief available. It's got quite a wide definition, even includes for removing things like Japanese knotweed. It may include if you have to divert main services. And as I mentioned, this allowance generously available to developers and investors. There are some time limits with this particular allowance. Ideally, you'd claim in the last 2 years. In some cases, you may be able to go back before that, 4 years or even further, depending on the circumstances. And as I mentioned, you can surrender this allowance to get cash back from HMRC, as you can with the enhanced capital allowances for carbon trust. So what is important when you're analysing property expenditure is you try to segregate the expenditure into the most generous allowance. So if you can, you allocate as much as is reasonable to the decontamination, getting the 150%. And then I'm not going to read out this list, but that is the basis of segregating expenditure efficiently. And there will, in a lot of cases, be some expenditure you still get no tax relief for, such as land and stamp duty. We have the budget lined up for 3rd of March, so just a few weeks away. One positive is that the annual investment allowance has been extended to 1 million for another 12 months. That's good news. So that means the first $1 million that you spend on plants can all be written off in the first year. There's been some indications that the new free ports, that the structures and buildings allowances will be accelerated, and instead of being spread over 33 years, they'll be spread over 10 years. And in the free ports, they will be reintroducing enhanced capital allowances at 100% write-off. The fact that they're introducing ECAs into free ports suggests to me that a form of tax relief for green energy is on the cards as well. And hopefully, Mr. Sunak, he will see the benefits of trying to stimulate the economy. I would hope that there will be some good incentives to encourage individuals and companies to continue investment. Now, in the post-corona world, what we are seeing is that landlords are having to do a lot more work to their buildings. I think it's fair to say that there's quite an oversupply now of particularly office retail space. So landlords are having to, where tenants have vacated, they're having to do a lot more in the way of strip out. And if a tenant has defaulted, we're seeing a lot of landlords now having to carry out works that would have normally been covered by dilapidations receipts. So there is a lot of scope for landlords on that kind of expenditure to claim allowances, maybe repairs, or it could be on plants. I do expect as well to see much greater incentives from landlords, and I think we'll be seeing a lot more in the way of landlords' capital contributions towards tenant fit out. That's an important area. We can help to allocate those contributions if we're acting for landlords so that the landlord gets the most advantageous allowances, or alternatively, if you're working for a tenant, you may want to try and structure it in an opposite direction. But it's particularly important where there are contributions on the table to consider early on who's going to get what allowances. So I expect there will be a lot of expenditure cleaning up, tidying up buildings to help with the marketability, and most of that should qualify for tax incentives. I've covered the key points that I wanted to go through in this presentation. We have had a few questions. I'll try and deal with a couple of them quickly. Someone has asked, can a local authority claim capital allowances? That's a very good question, because in the last 5 years or so, a lot of local authorities did buy commercial property as investments. And if the property was purchased by the local authority, it's not likely to be a tax-paying entity. So they wouldn't be subject to corporation tax or income tax on the rental profits. So in that instance, they wouldn't be able to claim allowances. Whereas some local authorities have set up limited companies, or even some of them have got offshore structures. And if they have set up companies or offshore structures like JPUTs, then they will be entitled to claim capital allowances. And we do work with a number of local authorities in that situation. Someone's asked, cashback is available only when loss-making or if profitable. Yes, typically you need to be loss-making to benefit from surrendering the enhanced capital allowances and the decontamination allowances. And for normal capital allowances on normal plant and machinery, to get a cash repayment, that would only be if you were profitable and had paid tax. So for normal plant and machinery, it's not possible to surrender those allowances for cash back, but you can offset them if you have corporation tax or income tax to pay. We had a similar question to the local authority question about charities. The same comments that I made for local authorities would apply to a charity. So if a charity had set up a limited company and was subject to corporation tax or income tax, then they would be entitled to claim. Another question here, if the building is, say, 30 years old and there have been several owners, how do you confirm if allowances have previously been claimed? This is a good question, and it's probably one of the harder things that we do as a firm. And the starting point would be to look in the sale and purchase contract. There can be some wording in some situations, and also to look in the CPSE questions. Those are the questions that the lawyers send to each other and the seller fills in. There can be responses in there. The other thing that we do is work with land registry, and you can get forms called HC1 forms, which will show you the history of the ownership of a property. And by then doing forensic research, you can very often piece the history. So, for instance, If you know from Land Registry that a company, the name of a company, you can look on Companies House if it's UK based to see whether it was an investor or developer or charity. You can use some common sense, you can make some judgments, but the onus is on the taxpayer to prove the history, prove the entitlement. And it can be quite challenging, particularly where properties have been owned by offshore companies. It's a lot more difficult with offshore companies to find out the history. Sometimes you need to speak to trustee companies, advisors. It's one of the reasons when you've got clients buying buildings, it's very helpful to be involved early. At an early stage, people tend to be a lot more cooperative in digging out history. There's a question about a REIT, and REITs are entitled to claim capital allowances. They do not, though, pay corporation tax. The benefit for a REIT in claiming capital allowances is they can help smooth dividend payments. So they are taken into account when calculating dividend payments. And there can be an advantage when a REIT sells a property. So if a REIT has notionally claimed allowances, it can enter into a Section 198 election when it sells. It can pass on the full value of allowances to a tax-paying investor. Another question here. Can capital allowances be obtained on an industrial building, replacing or oversheeting an existing profile steel roof? If the landlord adds insulation, improving the energy efficiency, would this make a difference? There's two potential types of allowances you could claim here. You may be able to claim structures and buildings allowance if you meet the requirements for SBAs, which on the face of this question you would. You may also be able to claim allowance as a repair. So the question in tax with repairs is it broadly a like-for-like replacement, or is there a significant element of improvement? There is quite some very good guidance in HMRC property income manuals. Be worth doing some looking at the revenue manuals. There's some quite nice examples. And for instance, they allow that if you've got a single glazed window and you replace it with triple glazing, they do not regard that as an improvement. So I think you'd have quite a strong case with an industrial building, provided you weren't changing the pitch of the roof and it was broadly like for like replacement, but allowing for some improvements in technology, that you would probably be fine to treat that as a repair. If the existing roof had asbestos, then you may be able to qualify for the removal cost of the existing roof may fall within decontamination allowances. There's a few more questions, so I'll carry on, and we will post more full replies. I will get someone who's much smarter than me in my team to give much more considered responses. I've not had time to prepare for any of these, so I'm doing it off the top of my head. Next question is, SBA is a form of depreciation. It is a form of tax depreciation. I would agree with that. Does it only apply if the purchase incurred after 2018? It's a little bit more complex than that. The building needs to have had its construction contract started on or after end of October 2018. So if you are buying a building, it's very important to get some evidence from the seller as to when the building works started and finished. And It may be that the original building was constructed well before that date, but if they did some refurbishment works on or after October 2018, you may be able to claim SBAs just on that proportion of the costs. So with SBAs, it's become very important to get records, particularly around the dates of when expenditure was incurred. What would be claimable on removal of asbestos from an office building about to be purchased? It's a good question. You would be able to, once you've bought that building, provided you remove that asbestos, let's supposing you appointed an asbestos specialist and they spent 100,000 on removing the asbestos, you'd be able to claim that cost. Plus, you'd also be able to claim cost of like asbestos surveys, any architect's fees, project manager's fees. You'd be able to allocate some of the builder's work in connection that directly related to that asbestos removal. So it is possible to add other costs associated with that asbestos removal and to significantly increase the allowances beyond the narrow cost of the 100,000 in my example. One question here, just to confirm, is there a clawback in capital allowances if the property is sold at a loss? Well, there's no clawback in terms of the capital allowances against income because you can use a section 198 to fix the disposal value. So you won't get a clawback in terms of the allowances that you've claimed, provided there is a 198 election. I think what the question is maybe referring to, I said there's no interaction between capital allowances and capital gains, which is true. There is, though, an interaction if you sell a building for a loss, and the allowances that you've claimed are taken into account in calculating the capital loss, and they will reduce a capital loss. So I'm glad someone's asked that question. I think the final question, can a tenant claim anything for the cost of environmental enhancements in a building? Photovoltaic cells, etc., where they have been installed at the outset by the developer and the tenant is just paying rent. A good question. You can't claim allowances on someone else's expenditure. So allowances go with a land interest. So if a freeholder put in environmental plants as part of the freehold, the freeholder will, if he still has kept the freehold interest, he will still have retained those allowances, and he can't in the UK transfer them across to the tenant. There is a mechanism in Southern Ireland to do just that, but we don't have a similar mechanism in the UK. So in the UK, a tenant is only entitled to claim allowances on tenant expenditure. So if a tenant adapts a landlord's freehold, then the tenant is entitled to allowances on tenant's expenditure. I've come to the end of the questions now. I'd like to thank you all very much for listening and wish you a good rest of the week. Thank you very much.